The world uncertainty index is like at its highest ever, like even higher than during wars or COVID. When you look at everything that's going on, do you think that growth will reemerge?
People always need accountants. We were talking about during the worst of COVID, the top 100 firms only grew 3%. Well, it's stunning that they grew 3% in the worst economy in 20 years or something like that. The only times that accounting firms really don't grow is when things are at their absolute worst.
Each year, Accounting Today releases its top 100 firms and regional leaders report. Today, I'm sitting down with the person who has the clearest vantage point on those numbers. I'm joined by Dan Hood, editor-in-chief of Accounting Today.
I would say this is just one thing we're noticing to start now, sort of general trend of declining partner numbers. And we're not seeing similar declines in staff numbers or professional numbers or anything else.
When you look at the fastest growing firms, are you seeing a correlation between their technology investment strategies and their growth numbers?
In a weird way, yes, but I would flip it. I would say I'm seeing a correlation between their growth and their technology investment. I think the firms, particularly the firms that are getting PE money, we did a survey of firms that had taken PE money late last fall. The number one reason was technology investments. They'd outsource some things and they'd automate some other things, and now they're excited about AI, particularly in its capacity for helping them automate tasks, the kind of tasks that they would give to the people they're finding it difficult to hire.
If it's a small firm, what's the one thing that you think they should be paying the closest attention to?
I would say that they should be thinking strategically because
Welcome to the AI Native Accounting Podcast, sponsored by Digits. I'm your host, Kacee Johnson, co-founder and executive director of the AI Native Accounting Foundation. Each year, Accounting Today releases its top 100 firms and regional leaders report, one of the most closely watched snapshots for growth, strategy, and structural change in the profession. Today, I'm sitting down with the person who has the clearest vantage point on those numbers. I'm joined by Dan Hood, editor-in-chief of Accounting Today. Dan and his team analyzed not just who grew, but how they grew. And this year's report tells a much bigger story than just revenue increases. This is not going to be a conversation about rankings. It's a discussion about where the profession is actually heading. Dan, welcome. I am so excited to dig into your 2026 report.
Casey, thanks for having me. Looking forward to it.
Yeah, so why don't you just kick us off by sharing some of the top insights and takeaways from this year's findings?
Sure. First things, I think for most people is to know that growth for the top 100 firms is higher than last year. Last year was about 5% or so. It's gone back up to what we think of as sort of for the past decade or so, a rough normal average of about 8%. A lot of that's driven by the top $15 billion firms who sort of make the weather. If they grow, that allows the growth of the smaller firms to show up. For those smaller firms, firms under $1 billion, we're seeing growth rates well above 10%. So double digit growth for them, strong as they have been for the past couple of years. Obviously, a big part of all this is M&A. That's driving a lot of the growth rates, and it's sort of making it difficult to tell, how firms are doing organically. But we know in terms of M&A, going gangbusters. Usually, we report about somewhere between 120 and 130 M&A deals among the top 100. This year, it was 225. So a huge, huge change there. A lot of that's driven by PE. I'm sure we'll get into private equity in great detail as we go on because it's changing a lot of the landscape of the profession and particularly of the top 100 firms. A couple other things to point out: growth strategies for the top 100 firms this year. They are focusing very heavily on client experience, client service, and client prospecting, business development. So all things around finding the right clients, bringing them on in a good way, and the strong onboarding process, and then serving them well and keeping them happy throughout the life of the engagement or the however long they're a partner. A client with you. And then finally, I would say this is just one thing we're noticing to start now, but is a sort of general trend of declining partner numbers. Very small declines, but nonetheless, we're seeing for a lot of firms of all sizes, slight decreases in partner numbers. Not at every firm and not all across the board, but more than we've ever seen before. And we're not seeing similar declines in staff numbers or professional numbers or anything else. So an interesting trend there. We're still trying to puzzle out. We have some thoughts on what it might be, but it is really we're just starting to see it. So those are some of the highlights of what we saw as we were looking at the numbers. There's a lot more, but those stuck out.
Well, that in and of itself is a lot to unpack. Now, um, so let's start with growth. You mentioned that growth rates for most firms have stayed steady, but that average T100 is up about 4%, largely due to a lot of the mega mergers among the billion-dollar firms. But if we strip out those mega mergers, what does, normal growth look like right now? And how are you seeing that when you compare it to, let's say, the last 5 years?
Right. So when you strip out the those $15 billion firms at the top, which are so huge, right? Their numbers sort of swamp everybody
Yeah.
else. For the firms that are between $100 million in revenue and $1 billion revenue, which is roughly 57, 58 firms, their growth rate was around 15%, somewhere between 15 and 16%. So that's a great growth. That's very strong, right? They should be very happy. And that's in keeping with what they did have done over the last several years. Similarly, for the firms below 100 million, which is a cohort that's shrinking over time as more and more firms, just the threshold gets higher. There's about 27 of those in the list. Their growth rate was about 12 to 13%, which again was in keeping with last year's numbers. So we're really seeing their growth rates and those of the firms just above them really hold steady. Firms are able to produce strong growth. Really, like you said, what it is those billion-dollar firms. If you have Moss Adams and a Baker Tilly combined, that's a huge growth rate. That's going to swamp some growth rates of the lower ones. If, say, for instance, you're relying primarily on your big four, which usually have 3 to 4%, that's going to depress the overall growth rate. So when you strip them out, the rest of the firms, the other 85 firms, are doing very well. Double digit growth is nothing to sneeze at. Similarly, when we look below our top 100 firms, I shouldn't say below. I don't mean to imply that they're less than, but the smaller firms that are in our regional leaders list, right? That's about 180 firms that we rank in 10 different regions of the country. Their growth rates are strong as well. In 7 out of 10 regions of the country, the average growth rate was higher than the top 100 firms' growth rate. So there's only in three where it was a little smaller. And again, sometimes that's a case of a firm getting merged out through to up into the ranks into the top 100, that sort of thing. So overall, we're seeing pretty strong growth, double digit for most of the top 100, and then strong at least above that 8 to 9% of the top 100. We're seeing for a lot of firms throughout the rest of the country.
It's very healthy. Now, I remember, Dan, a few years back, it was like at the beginning of COVID, and we had you on an AICPA town hall, and growth was tremendous for a few of those years. Do you feel like this current cycle right now is sustainable, or is it like a consolidation cycle?
It's interesting, it's difficult to know what growth, how much of the growth rate is attributable to organic growth and how much is attributable to M&A. M&A is obviously playing a huge role. I mean, I mentioned that that jump from 125 to 30, which is the average for the past 4 or 5 years, to 225 mergers. That's going to propel a lot of high level growth. I think it's sustainable in the sense I think there's a lot of money out there looking to acquire accounting firms. I think there's enough accounting firms to be acquired to keep it going for at least 2 to 3 years. Then you start to wonder, how what else is there to buy if everyone's bought everything? But I think it's sustainable for a while. I think there's enough interest, not just among PE firms, but among all kinds of other potential acquirers to keep it growing at this level. Now, at some point, people are going to stop wanting to buy accounting firms, or there'll be no accounting firms left to buy. But I think that's 3 to 4 to 5 years down the road.
Yeah, I mean, that stat is incredible from 122 to 225. I mean, what changed in the last 12 months to cause such a spike? And I mean, obviously, there's got to be some influence by PE pressure.
100%, 100%. You hit the nail on the head. That's what it is. This year, we had a number of PE-backed platforms come in strong. Your Sorens, your Elevates, your platforms, your Springlines, your Ascend. Some of them had been operational for a couple of years, but they made big jumps this year. What we also saw was a lot of their member firms going on going on acquisition tears. So which you have that sort of two levels. You have the platform, the PE-backed platform acquiring firms, and then the firms in that platform going out and acquiring other smaller firms. So I think we're going to continue to see that. I wouldn't be surprised. Maybe it doesn't stay up at 225. That's pretty high, but maybe it sticks around 200 or 180 or something like that. I think it's going to be elevated over the previous 5 years because of these players are still relatively fresh in the field. There's still plenty of room for them to expand, plenty of regional expansion for them to consider, plenty of tuck-ins for them to consider. So I think there's still room for a lot of that kind of acquisition. So I think we're going to see that continue.
I know Accounting Today hosts the PE Summit each year. I got to make it out this year. But I'm so
You love it.
interested because I'm sure you've got a ton of insights and things that you hear when you're there. Are you seeing firms feel pressure to bulk up if they haven't made a move in that direction yet?
I think for a certain, this is one of those things where there's so many different sizes and types of firms in the profession. That I think for a lot of smaller firms, let's say if there's 400 or 44,000 firms in the profession, maybe 35 to 40,000 of them, small Main Street CPA firms, they're probably not feeling the pressure. But when you start to get larger, start to get in that top 1,000, top 500, I think they're starting to look around, and maybe they're not feeling pressure, but they're certainly thinking, I ought to be thinking about this. I ought to be looking at it. I ought to be figuring out what my future looks like. And you certainly hope they are, because what's going to happen is the firms that have PE backing are going to change the landscape. They're going to be much more competitive. They're going to be competing for staff. They're going to be competing for clients. They're going to have deep war chests for acquisitions. That's going to change the value of firms. And so I think that I don't think firms have started to feel the pressure. I think they're going to, and I think they're best off now starting to think about, how do I compete with a PE-backed firm across the street?
Well, yeah, and to your point, I mean, you said that all 5 of the new firms of the top 100 list are PE backed. So they've they've got to be feeling some of that pressure. But I'm curious because you talk with so many of these firms. Are the PE backed firms fundamentally different operators or are they simply just better capitalized?
I think they're certainly better capitalized, right? That's a big part of it. And it's a big part of why other firms need to think about them as competitors, even if they have no intention of taking PE money. I think we're still feeling our way along how different they are. There's certainly a sense of that they are held more accountable. The more of those firms that we talk to, the more they sort of say, "Well, the amount of reporting I do to our PE partners is much greater than I ever thought," and the number of KPIs we have around our firm, and the sort of seriousness with which we take goals and plans is much more than it ever was before. I don't think we've yet seen it to the point where they're really transforming the firm so much as sharpening them, sort of making them, like I said, more accountable to goals, to plans, to goals that are set for partners, that sort of thing. I don't think we've yet reached the point where we say, wow, this is really not looking like an accounting firm anymore. It's just a hyper efficient, hyper focused accounting firm. And then again, then that's not even all firms. In many cases, a lot of the acquisitions some of the PE platforms made were they went into a firm and said, "You're doing what we want. Keep doing it. And here's a war chest to go out and acquire other firms to bolt onto you. But we don't need you to change much. We may ask for more reporting. We may ask for more details. But your strategy is why we acquired you. So keep up with it."
Yeah. So the DNA is not changing, but maybe the operational layers. So I'm curious because when you were talking about, um, how many firms there are left to acquire, do you see us heading into kind of a barbell profession where we've got mega firms on one end and niche boutique firms on the other?
Kind of want to say that would be where we'd headed. It makes sense. But the more I think back over the profession, I think we had that for a while. If you looked at the difference between the sort of $1 billion firms back when even when there were only 5 or 6 of them, and then when you look at this list, the vast majority of this list would be below $200 million of the top 100 firms. I think interesting now we look and we see there's a lot more firms in between, say, 200 million and a billion, in part because they're getting PE money and they're starting to bulk up. And so maybe their goal, all of them, is to end up being $1 billion firms. So that sense, yes, that makes some sense. But I think we're going to see other firms rise up into that space. So I think we won't necessarily have that $1 billion, that barbell shape. What we may have is a lot of firms moving more rapidly through those stages, right? Going from being a $30 million firm to a $100 million firm to a 200 to an 800 to a billion. I think we may see more firms uh, going through that procession than we used to. I think mostly we had a lot of firms that, so I don't want to say stalled, but they would sort of stop somewhere between 60 and 150 million, right? You'd have old firms would always be kind of there and they'd grow a little bit every year just to keep up with the general growth of that cohort. But they wouldn't be leapfrogging into new areas. I think we're going to see a lot more firms going through that, leapfrogging through it towards $1 billion. Whether they ever get there, I don't know. Does that make sense? Is a sort of, I think
It
we're going to
it
see it.
does. I'm kind of placing hourglass economics on it as you're talking about it. Like that's where what I'm seeing about the middle kind of being squeezed a little bit.
Yeah. Well, I think what we may find is that metal gets shoved down a little bit, right? That
Yeah.
where people start to get acquired becomes much smaller. We're already seeing PE firms going after, it used to be $20 million was the smallest they consider. Now it's 10 million. Now it's 5 billion. And who knows at what point they stop and just start, acquiring accounting students before they get out of college. But uh,
So now you also mentioned that two of the big four reported declining partner numbers and that we're seeing flat or shrinking partner counts in smaller firms as well. That may not make the big headlines, but it is significant, especially when we talk so much regularly in this profession about, business model transformation and different kinds of equity ownership for all staff, not just partners. So are you s are you thinking though that this, reduction in partners is primarily retirements, or is this something that's more intentional structurally?
Well, I think it's driven by retirements, right? There's a huge proportion of just the partnership ranks of the profession that are baby boomers who could have started retiring 5, 10 years ago, even immediate impetus behind it. The real question is why aren't they replacing them, right? Why aren't they finding new partners to bring up in the ranks? That's part of the long term pipeline problem of the profession. I think we've also got the issue that now people are looking at private equity and saying, well, with private equity coming in the mix, do we really need to have that next generation of partners? Are we all gonna look so different that it's not as urgent an issue to bring up new partners?
Right, well, if I was a young emerging leader in the profession and I see that the firms are growing, but the partner ranks are shrinking, I mean, I'm gonna start to ask, what does that mean for ownership and control for me in the future?
Yep, yep. It's interesting because you talked about different levels of equity, and I was thinking about, as much as 10 years back, people really started to talk about equity versus non-equity partners. You saw a lot of firms creating those two distinct classes and offering that to try to bring in the new partner levels. We hear a lot less about that. It tends to be much more common in mid-sized firms, or what we consider mid-sized firms, so firms below the top 100. And and I think we're going to see less of that as we go on, as firms start to say, well, do we need non-equity partners? How do we do this? But then, as you say, that discourages or disincentivizes younger people if they say, "Well, can I be part of a firm, become an owner over time?" On the other hand, we're seeing with younger generation, maybe they weren't that interested. Maybe it's fine with them. They'll just go and work for a firm for a while and then go work for a different firm, move around, and the profession will have to restructure itself in such a way that it's not relying on that next generation of partnership coming up to keep the firms functioning.
Yeah, 'cause it used to be a two-track, right? When you're defining the partners, but now it's almost like early signs of maybe it's a new definition of what partner means.
Or does it need to be a partnership at all, right?
Yeah.
Does it need to be, if you're owned by a wealth manager or if you're a public company, do you need to have partners? Do you need to have owners? Do they all become
Yeah.
directors or vice presidents and can take their pay and salary or stock options?
I feel like we could do a whole episode just on the business models, Dan. But all right. So another thing that you shared, and this one didn't surprise me because I think CAS has been just the rocket ship of the profession for a few years now, and you cited that it is an important growth engine for many of these firms. But I'm curious, what do you think is preventing it from becoming a larger percentage of the total firm revenue?
Right. So yeah, so this is specifically for top 100 firms. For smaller firms, CAS has a much bigger portion of their revenues. I think some of it is just literally just their revenues from other areas are huge, and so for a lot of them, CAS is a relatively new player. So some of it's just you're starting from a small base, so it's hard to become a big part of the revenue of a firm that already has a giant audit department and a giant tax department. I think some of it is also though that larger firms I don't think have grabbed the CAS opportunity in quite the same way that smaller firms were. Some firms that were a little nimbler and a little maybe closer to particularly small business clients who were, great, great, great potential clients for CAS. So I think it's a combination of all those things. Larger firms, it's more difficult for them to start up newer service areas. There's a lot of questions about how do I make sure that all of our clients are brought into the CAS department or made aware of the CAS opportunity that we offer. You have a lot of partners saying, "Well, let's you do that with somebody else's clients, and then come and see if you want to bring it to my client." So all those things together, I think I won't say they're inhibiting the growth, but they're maybe slowing it a little bit. There are certainly some top 100 firms that have great, thriving, booming CAS practices, and in fact, as I said, as you noted, something like 85% of them said that it was a source of growth, said that the CAS was a source of growth, and about a quarter, about 20%, said that it was the biggest, fastest growing practice within their firm. But I think it's still for these large firms, it's they're coming to it a little later than some of the smaller, more nimble firms, and they have some of those internal hurdles that make it a little difficult for it to grow as quickly as it might at a much smaller firm.
I do think that you nailed it on the head, though. That is such a blocker for a lot of these, CAS practice leaders that are still getting that old mindset from maybe a tax partner of, "Oh, no, don't touch my client. I don't want you messing them up." And it's like, no, this is the firm's client, looking at it in a more holistic approach for the client's sake too. Yeah.
And I would throw it on that. I mentioned that the sort of focus on client service, one important part of that is cross selling. All of the top 100 firms, I can say all the top 100 firms, but a lot of the top 100 firms reported cross selling as an important strategic growth strategy for them for 2026 was to make sure that as many of their clients as possible were exposed to all the different kinds of services that the firm could offer. So I think you're absolutely right that they're looking at that, they're taking it very seriously, or recognizing that it's an issue.
Well, and I think they need to run it from a different lens. Like my background is from tech. And so to us, it was like you're cross-selling everything you can because the more tentacles that you can get into a client, the longer you're going to keep them, the harder it is for them to move. So I think they just need to approach it, maybe look at what other best practices from other industries do.
I said we asked for growth strategies, and every year some firm says, "Oh well, this year we're focusing on a one firm strategy, right? That it's not just individual books of business; it's we're a one firm." And it's like, well, like this is a 30-year-old idea in the accounting profession. Like, why are you just discovering the one firm idea this year? It should have been something you sold, sold that way a long, long time ago.
Yeah. Well, and another thing we've been talking about for a while that you touched on in kind of the top insights was like the picking better clients. This is super interesting to me because I swear we've been talking about for 10, 15 years now, like you need to fire your bottom 10%. Do they finally feel free to fire?
They've definitely started talking about it a lot more, not just this year, but over the last 2 years or so. And I don't know if it's that they feel free to fire or that they're the capacity issues that all firms have been facing have made them say, "We just can't do this anymore." It's not that we want to. I mean, I think most accountants are uh, very loath to fire a client, right? What if we never get another one? I think they're starting to, one way or another, realizing that they have to. Whether it's, I don't know that it's necessarily that they think they can, so much as that they just have to. They can't do all the work they have. Some firms are definitely looking and going, "Wow, we don't have to do this anymore. We're doing great." Particularly ones that have strong, booming niches where they got a very strong growth, and they can say, "Wow, we could do all this. We don't need to worry about those other clients." But I think for most firms, it's really just a question of we can't get that work done. So
So a capacity strength, maybe not an intentional strategy here.
yeah, it's a response. It's a response to pressures elsewhere, as opposed to saying, "Hey, this would clear the field for us to focus on the people we really like, who are most profitable for us, who are most interesting for our staff, who are, just all around the people we want to work with, as opposed to the people we have to work with because they'll sign a check."
And they'll enjoy their job so much more.
Right?
I like that. So, Dan, when we talk about CAS scale and onboarding, client selection, technology is inevitably part of that story. This is an AI podcast, so we got to address the AI questions. So, I'm curious from your vantage point, when you look at the fastest growing firms, are you seeing a correlation between their technology investment strategies and their growth numbers?
In a weird way, yes, but I would sort of flip it. I would say I'm seeing a correlation between their growth and their technology investment. I think the firms, particularly the firms that are getting PE money, we did a survey of firms that had taken PE money late last fall, and their number one reason for taking PE money, we thought it was going to be for expansion or for paying out for partner retirements. The number one reason was technology investments. So I think what's happening is it's actually the growth, whether it's PE driven or just organic or their own traditional M&A, as they're growing, one of the things they're doing as they grow is invest in technology. In other words, so it's not the technology isn't fueling the growth, but it's the growth is pursuing the technology to enable further growth.
That's interesting. Do you know, are the PE-backed companies that are doing a lot of technology investment, are the PE firms getting involved in those decisions?
In some cases, yes. In some cases, they're actually going out. I mean, for instance, I always think of Ascend, for instance, hired an AI leader to go out to the firms and help them figure out, go to the member firms of that platform to figure out, what should you be doing in AI? How should you be leveraging it? And I think there's some others that have done similar thing. And I think the particularly the more forward thinking platforms have been going out and talking to their firms about what kind of technology should you be using, how should you be thinking about it. I think they're helping them in many cases up their game when it comes to technology, figuring out what to leverage, what tools to use. In some cases, not many, but in some cases, they're talking about sort of uniformitizing, if that's a word, the tech stacks across the platform, trying to get firms to use more of the same tools to help them be, to so that among other things, the platform can then in turn help them with those tools, right? If you're all using the same tools, you can come to us and we can help you solve problems with it. If you're all using different tools, that's a different question. But I think you're definitely seeing particularly the platform PE firms, the ones that own a number of different accounting firms, doing that, really going out and helping their member firms get better at technology. For some of the single source, where it's a single PE firm owns or buys a big accounting firm, I don't think they're necessarily doing that as much, though they certainly may be bringing some expertise to it. But I don't think they have quite the same focus that the platform firms do.
Hmm. Interesting. This makes me think all about the ROI conversation of AI for firms. And I remember I was talking about 2 years ago as we were kind of researching practical use cases of AI, and we tried to figure out what the true ROI was for firms. And maybe it was just too soon, but a top 10 firm basically told me, we could throw out numbers in a board meeting of, oh, this is saving us $60 million, but it's all kind of BS because at this point we can't give a true ROI of what this AI investment is giving us. Do you feel now, 2 years later, that firms are being able to credit AI for measurable gains, or is AI still more narrative than reflected in hard numbers?
I think for most firms, it's still narrative. There are a few where it isn't. There are a few where they can point, if they will. So I know, we specifically know some firms that have reaped tremendous benefits in terms of staffing, and by that I mean lower staff numbers, literally being able to attrit, like through attrition, lose staff and not have to replace them because they've got AI working on it. They won't use to say that for public consumption, but we know some of them that are. But I think most firms are still in the trying to figure out what it's worth and what it does. The interesting thing I think about all this, though, is that a lot of the ROI is we didn't fall apart, right? We didn't collapse. And this goes to automation and outsourcing as well. It's one of those when we talk about the capacity issue. All of these tools that firms sort of scrambled to bring in because they couldn't find enough people, right? So they'd outsource some things and they'd automate some other things, and now they're excited about AI, particularly in its capacity for helping them automate tasks, the kind of tasks that they would give to the people they're finding it difficult to hire. A lot of the ROI is we got the work done because we had these other tools in place, and I don't think firms have disentangled that yet, right? It hasn't disentangled the benefit of having these what they thought of as sort of stopgap solutions. We couldn't find a person, so we did it with AI, or we couldn't find a person, so we outsourced it. And I don't think they're yet realizing the huge benefit they got from having those alternatives. And I think that's going to be true of AI for a while. They're going to, because that's one of the things when we talk to these firms, they always talk about AI in terms of efficiency and automation and replacing capacity that they don't have. And I don't know that they're going to measure that properly. They're not going to measure the sense of, wow, yeah, we got to get all this work done because of this. They're just thinking of it as a temporary replacement for staff.
Yeah, I couldn't agree with you more, Dan. And I mean, the gains are real, they're there. It's just a matter of, I think it's human nature for accountants to want to have measurable
Sure.
ROI and dollars to track back to things. So that's where I think there's just still a gap. But
And it's quite it's a huge and excellent point, right? They'll need to measure it, and they just need to look at different things to measure it. It's like,
yeah,
how do you measure how many people didn't quit because they weren't forced to do, 30 extra hours a week of grunt work? And, how many clients stayed with us because we completed their work on time because we had the AI to do this kind of thing. This is all difficult to measure.
yes, 100%. And I'm curious, when you look out 3 years, I mean, do you believe that these AI enabled firms will materially outperform their peers in these rankings?
That's a great question, and I am not sure, because I look out 2 years and I wonder, will everybody just be using these tools, in part because they're gonna get baked into the work, the tools that accountants are using anyway, so it won't be really you won't think of it as a firm using AI, it's just everybody uses this because it's baked into our, the tax prep software that everyone uses and the accounting software that everybody uses and so on. So, I certainly think if there are firms that aren't using, that aren't tech enabled, really aren't tech, like consciously aren't AI enabled, they're going to lag behind, no question. But I think so many firms will be AI enabled whether they like it or not. You know what I mean? It'll be built into their systems that it'll be tough to tell.
Yeah, I mean, even us as consumers, if when it's so funny to me when people are like, "Oh, no, I don't use AI, I don't trust it." And it's like, you're probably using it in 10 apps that you have no clue you're using it in, but
It's the same as the old cloud-based thing, right? People say, "Oh, I would never trust the cloud. I'm not gonna I can't trust the cloud." It's like you already bank in the cloud. You do, you get your all your entertainment through the cloud. Why wouldn't you put your client's accounting software on the cloud? It's, you've been using it for a long time. You just didn't know.
exactly. Well, at this point, it's table stakes for all the vendors anyway, so they're rolling it out. But when we're talking about these categories, I am curious because CAS is one of the fastest growing practice areas. Do you see AI helping scale CAS practices, or just kind of simply improving margins?
I think that goes to the firm, and this is one of the things that's so complicated with the profession is that there's so many different sizes of firms doing so many different versions. CAS, there's 1,000 different versions of CAS, and everybody does it slightly differently. Each firm's version of it is slightly different. I would say that, for the consciously AI enabled firm, I think it's going to do both, right? It's gonna increase margin and it's going to increase capacity, right? They'll be able to scale to far larger numbers of clients than they could in the past, while also, reducing costs. If you're not thinking that deeply about AI, maybe you won't reap all those benefits. But again, you're still going to be using it one way or another because it's going to get baked into the systems you use already. So I say for consciously enabled AI firms, firms that are really seriously leveraging AI, I think it'll do both. For those who aren't, maybe it will only just increase margin. Or allow them to keep their heads above water, right? Allow them to do all the work they've been saying they'll do for all the clients they want to serve.
Yeah. At this point, I can't imagine my life without AI. I'm gonna be honest. I'm like, how did we ever work without it? I don't know. But
Right.
so Dan, I know that you are just now publishing the 2026 report, but I'm curious, looking ahead to next year's, do you think that PE will continue to dominate some of this growth story?
Yes, absolutely, 100%. Hey, PE and M&A, and we may see other forms of M&A come in. I wouldn't be surprised if we see more non-PE firms, non-accounting firms move in, more wealth management firms, more. We were talking about, would a sovereign wealth firm ever want to come in? There's always, experts in the field who will say, this is the year we're going to have a couple of IPOs from big accounting firms. I wouldn't be surprised if we saw an IPO in the coming year. But so I think the while PE will continue to play a role, I think other forms of outside investors will come in, and I think probably the big thing is to say that that M&A will continue to be, whatever form it takes, will continue to be the real driver of growth for a while. Organic growth will continue, but the top level growth is really going to be driven by M&A.
And I'm curious too if you think that organic growth will kind of re-engage as a bigger driver. I mean, Barry Melanson always said that the profession was well positioned, that whether the economy was doing really good or it was doing really bad, this is when the firms are more needed than ever. And I just saw that the World Uncertainty Index is like at its highest ever, like even higher than during wars or COVID. So, I mean, when you look at everything that's going on, both in the US and globally, do you think that growth will reemerge as just kind of a bigger driver?
People always need accountants, even right. We were talking about during the worst of COVID, they only grew firms. The top 100 firms only grew 3%. Well, it's stunning that they grew 3% in the worst economy in 20 years or something like that. The only times that accounting firms really don't grow is when things are at their absolute worst. I think we've had 3 years of of declining growth or shrinking in the last 30 that we've done the top 100 firms, and those were exactly what you would expect, right? 2008, 2009, and so on. I think that organic growth will continue. Again, it's sort of difficult to strip out because there is so much M&A that it sort of swamps everything. But I think organic growth has been ticking along at accounting firms. I don't think most firms are relying um, are ignoring it. Let's put it that way. I think they continue to run organic growth strongly within their firms. It's just M&A is such a quick way to bolster that and to put a big jump on top of it that it sort of helps us forget that organic growth is just happening on a regular basis. How do you um, strip it out, it's difficult to tell. We'd have to get the firm to report it individually, and that's difficult to get them to do because then they'd have to tell you what the acquisition was and how much they paid for them. I don't know that we should expect organic growth to grow. That the rates of organic growth will grow significantly over the next several years. Though I wouldn't be surprised if firms got more intentional about it. You would hope that as they get more serious about their growth strategies, that they're able to measure that and to figure out the right ways to approach it, which I think is likely. I think in the past, growth rates for particularly for organic growth or growth plans for organic growth have not been perhaps as systematic and as organized and as well thought out as they should have been. That's one thing we're definitely seeing among the top 100 firms is that their approaches to growth are getting more um, systematized, more thought out, more well thought out. They're putting more data behind them. They're putting more technology behind them, so that in the end, yeah, if that might grow organic growth, but I don't know that it'll grow it to the point where we can really say, "Wow, organic growth, that's crazy," as opposed to the M&A. M&A is always just going to be for the next several years so high that it'll swamp it a little bit.
So, Dan, I know we talk a lot about the top 100 because that's the focus here. But it's a small firm reading this report, what's the one thing that you think they should be paying the closest attention to?
I would say that they should be thinking strategically. I think that that's the most important thing an accounting firm of any size can do is think strategically about their position in their market, whatever it may be. Because one of the things we're seeing for all of these larger firms is that they are looking at every region and every niche and every client type and every service area and saying, what can we do? They are casting around and are thinking about, hey, can I eat your lunch? Can I eat your lunch? And no matter how small you are, there's a firm that's looking at your client base and going, I might be interested in that. I shouldn't say that. There are some client bases they are not interested in, but by and large, you're not safe just because you're small or in a a rural area or a place that's less traveled. There are firms looking to compete with you, and you can't afford to not have a well thought out plan for what you're going to do with your firm. But how you're gonna protect yourself against that kind of competition. Doesn't mean you have to be a huge grower, a big growth firm and go out and get PE money and start buying other accounting firms. There are ways you can run the small firm you're running now, be very happy with, run a strong lifestyle firm if that's what you want. But you do need to be intentional about it. So I think that's probably the main message is don't assume that what you're doing now is going to last forever or that you won't have to make changes in the face of all these other changes that other firms are making.
Yeah. When you finally closed out all of the data and you guys looked at this, was there any one thing that stood out and surprised you where you're like, did not expect that?
It's still that huge jump in M&A activity because, like I said, for 4 or 5 years, it had been somewhere between 120, 130 to the point where I just assumed, yeah, when I count them up, it'll be that because we sort of counted by hand, going through all the different reports, and when I got to around 150, I'm like, well, this is a lot more than last year, and somewhere around 200, I'm like, but I must have counted this wrong, and then when I got to 225, I was like, there's something wrong here. There isn't. It makes perfect sense when you look at the trends, but it was such a huge jump. And your question about whether it will last next year is I'm fascinated to see if it does. I think it probably will, or at least it'll be much elevated over the previous 5 years. But it's such a big jump that you have to wonder: is this just a one off?
Yeah, when I think about how much the top 100 has changed just in the past 5 years, I mean, I think now looking forward, we're in 2031, and you think about the logos, what does the top 100 look like then?
Yeah, yeah. How many of the names that we think of as permanent on the list will be gone? At some point, I went through and go through and look at all the abbreviations and think, all right, what three firms created that abbreviation? What three firms went into that name? Now, you think about a CLA. Well, there was three firms that made CLA. No one said their names in 15 years, kind of thing. So it's massive change all the time.
Absolutely. So, Dan, I always like to end on a more personal note for our audience to get to know our guests a little bit better. Now, for those of you that have not had the pleasure to be at a conference with Dan Hood, he is a karaoke master. So, Dan, what is your favorite song to sing in karaoke?
All right, I got to go with it's United States of Whatever by Liam Lynch. Classic. Classic,
Okay.
and very, very short, and you can shout most of it, you don't have to say.
Now, what about is it different if it's you and Seth up there together?
No, it's just 2 people shouting it at that point.
Okay. It's just louder. Excellent. Well, Dan, every year this report gives the profession a mirror, and this year I think the reflection feels a little bit different. But big kudos to you and the team for producing another great report. Thank you for walking us through the numbers and, more importantly, the story behind them. It was great to have you on. Thank you.
Cheers. Thank you for having us. It's always great.
And to our listeners, the Accounting Today Top 100 and Regional Leaders Report is now available at accountingtoday.com. Take the time to read it. It's not for the rankings, but more importantly, the signals. If you are building an AI native firm or thinking about what your growth strategy needs to look like in a consolidating market, visit digits.com to learn about the world's first AI native general ledger. Thank you for tuning in. You can stream all of the AI native accounting podcasts on YouTube or your favorite podcast platform. Until next time, I would say this episode makes me think stay informed to stay ahead.